Hey everybody, hope everyone's doing well and had a good day. This is an overview of the Emini 5-minute chart for Monday, September 9th, 2024. So it's the start of the week, and on the daily chart, on the weekly chart, we have a lot of overlap in two-sided trading. We go up for a couple of legs, we go down, we go up, we go down. And here's what we had at the end of last week. A 3-bar bull micro channel. An outside bar, it's a high one at the top of a trading range, and then a big sell-off. The bulls not willing to buy the high one. It's bad context. It's a double top. And we have to go lower to find buyers. You can see we're coming close to the stop order. The stop order of this bull reversal bar. We got vacuumed down to that price. And the odds are there's support at this price level. Because if you think about it, if you're a bear and you see a 4-bar micro channel and you sell here, you're disappointed with your follow through. And if you're a bull and you see the bear micro channel, you decide not to buy because the signal bar is big, the risk is big, probability is low, you're buying against a micro channel. So if you're a bull, you don't buy. So in either case, traders are trapped. Bears who sold, trapped into a bad trade, and bulls who did not buy, trapped out of a winning trade. The result is an imbalance. So if we come back to this price, there's probably support, and we're probably going to bounce for some sort of second leg. And then on the daily chart, trading range, overall, the bars are sideways, big down, big up. We had an expanding triangle here with a bear breakout, but the bear breakout had weak follow through. Decent trend bar, but a doji and then another doji. And then on Friday, we had another bear trend bar. Now there's a couple of problems with that trend bar for the bears. And the first problem has to do with the overall context. The market is in a trading range, and we had this rally on the daily chart. Consecutive buy climaxes, yes, but micro channel with very little selling pressure on the way up. We went sideways. We're expecting a second leg up, but it is a trading range, so deep pullbacks are common. And one of the most common pullbacks level of any move is the 50% pullback level. And you can see that's about where Friday tested. So trend bar, yes, but it's a sell climax and then disappointing follow through, and then another sell climax to support. It's also a breakout point. You can see the August 13th bar as a measuring gap, and we're testing that breakout point as well. And then one other problem with this trend bar for the bears, it has to do with the 5-minute chart. So I'll get into that. And this is why it's important to sort of crack open a bar and see what it looks like, what happened intra-bar. And we can see on the daily chart there's prominent tails above and below the bar. But when we look at the 5-minute, we see a sell climax, but then a lot of the day, maybe half the day, was more sideways. What that tells us, and sure it was a bear channel, we're getting lower highs and lower lows, except for here this was actually a higher low. But the problem, I'll draw it this way. So even though it's a big bear trend bar, you can see the market was sideways for more than half the day. And sideways, or trading range, means breakout mode. And I actually want to bring it back to over here. So there's a couple of points I want to make on the 5-minute chart today. So over here, what I'm drawing is a contracting triangle. So basically a horizontal wedge. 1, 2, 3, 1, 2, 3. So the market's contracting, it's breakout mode. And then we had an attempt at a bull breakout, reversed, and then we ended up getting a bear breakout. And it was a bear breakout and channel, spike and channel, bear trend. But look at all the overlap, especially in this area of the day. The market's basically neutral. And when that's the case, the market is back in breakout mode. And breakout direction is about 50-50. So it's not necessarily a lot higher probability that we're going to get a bear breakout after this trading range. And when you know the higher time frame context, like I mentioned on the daily chart, it wouldn't be the craziest thing if we get a deep pullback. So with that said, coming into the day, we had a fairly big gap up, and bar one's a bull bar, so the market accepted the gap up. Now, if you think about it, you think about major trend reversals. Here's a spike in channel, bear trend, and then we had this gap up, which could be thought of as a spike. And I'll pull up the Globex chart so we can see what the market did from Sunday evening into the open of today, because that gap is pretty significant. So here's the open of the session. This was the close of Friday, and here's what the market did coming into the day. You can see it's a tight bull channel. The bears had an attempt here at a reversal, but in a trend, 80% of reversals fail. And you can argue tight bull channel and then a trend line break, and the bears got a bar completely below the moving average. But this just isn't enough bars for a major reversal. Is this enough to undo all of this? Probably not. So the bears are hoping for some sort of major trend reversal. And I might scroll into the day while explaining this. But okay, bull breakout attempt but failed. Another bull breakout attempt but failed. So the bears hoping this is a higher high, major trend reversal. But now this breakout's strong enough for its own second leg. But the point is, coming into the day, looking at the Globex chart, it's a tight bull channel, and that's a decent bull trend. So the gap up has some credibility. So with that said, one more thing. Here's a bear channel at the end of Friday. Bear channel means bull flag 75% of the time. You get a bull breakout of a bear channel. So here's our bull breakout in the form of a gap up and follow through. So with major trend reversals, the expectation is first a trend. So here's a bear trend, a trend line break, which we have here up to bar one, and then a retest of the trend's extreme. And only then the bulls will look to buy for a swing and a major reversal. So bar one, good for the bulls. We gapped up and the market accepted the gap. And then a doji, bear bar, doji. Is this enough to reverse the gap up? Probably not. This is a minor reversal. While I do think we're going below bar one, because only 20% of days, it's only 20% of the time that bar one will remain the low or the high of the day, and 80% of days have trading range opens. So I'm always expecting a trading range on the open. But for now, this looks like a minor reversal. The gap up needs at least a second leg. We're rallying. We have a 4-bar micro channel now from bar 4 to bar 7. Maybe it's 2 legs up, but if you judge the context, the big gap up, we're getting more bull bars than bear bars. The bears really just have one bar. Otherwise, the bar is a doji or a bull bar. And now we have a 4-bar micro channel. Probably more buyers below bar 7 and probably going to go higher. This might need a second leg. And then we went outside up on bar 8, so we pulled back and we're reversing up. But now at this point, with the gap up, we pulled back below bar 2, so that's this pullback terminates leg 1. So leg 1, pull back, leg 2, and then that leg is terminated by the pullback on bar 8. So 1, pullback, 2, pullback, 3. The bulls are starting a third leg up. And if you think about the market cycle, leg 3 has the highest probability of failing, or at least having a deep pullback before continuing. So buying here can be dangerous. And then bar 9, we had a big bull trend bar. And besides bar 1, looks like bar 9 was the biggest bar of the day. And bar 9 could be a profit-taking bar for the bulls, sort of profit maximization. It's a little parabolic. We know it's leg 3, 1, 2, 3. And there's a big tail on top of the bar. And that's not what the bulls want to see in a breakout. In a bull breakout, bulls want to see bars closing near their highs. And then we got bar 10, a bear breakout, and follow through bar 11. So if you think about it, now we've had 3 legs up, the market's high above the moving average, and now we have a bear breakout and follow through. Bars 10 and 11, strong enough for a second leg down, probably sellers above and lower prices. We may have to test the moving average and below bar 1. So when we've had 3 legs up and the market is far from the moving average, we may have to revert to the mean. What I mean by that is the moving average is one measure of average or of a mean price. We call it the moving average, the average price. And now the bulls have had 3 pushes up, but the third push was climactic and followed by a decent reversal. So for the short term, the market might be always in short. We're probably going to get a second leg. But in the bigger picture, we had this big gap up and follow through buying. I wanted to mention one more thing, because this pattern, the breakout and a small second leg, is so common. See if I can find a quick example. This is it's not ideal, but you see a strong breakout, a pause, and then a second leg. Is bar 54 the second leg, or is it simply part of the first leg, and then we get a more complex pullback, 2-legged pullback, and then a second leg? So that's kind of what I see on the open. I see the gap up as this breakout, the move up to bar 9 as the brief second leg, but it's really part of the first leg. And then the expectation is a more complex pullback, and then a second leg. So that's where we are on bars 10 and 11. Bull breakout and a minor second leg, but it may be just part of the first leg. But now this might be the start of a correction, and we need at least one more leg down. The bears getting follow through, we get to the moving average on bars 14 and 15. So for the bulls, the gap up and the follow through, good for the bulls. Maybe the bulls want to buy the moving average, but the bulls see a 6 or 7 bar micro channel with no bull bars, and that's a problem. This is probably going to get a second leg down. So the odds are there's sellers above the first pullback. If we go above bar 15, or the first time we go above any bar, the odds are there are sellers above for a second leg down. 16, a good bull bar, but probably a minor reversal. Is 16 going to undo all of this? Probably not. The bulls can buy, but if the market doesn't just race up, then they probably need to give up and look to buy lower. This is still strong enough for a second leg down. So disappointing bar for the bulls. Maybe they just give up on the trade. That's what happened on 19 or 18. 18, bear breakout, but it's just one bar. So it's a breakout bar, but the bears still need follow through. And then bar 19, they don't get follow through. So at this point, the bears have 2 legs down, 1, pullback, 2. Now bar 18, that may have been strong enough for its own second leg. If you think about bulls who bought below, or any trader, bulls who bought below 17 are trapped on 18, and bears who did not sell because it's consecutive bull bars, it's a weak stop order, sell signal bar. They didn't sell. Now the bears are trapped out of a winning trade. So the low of bar 17 becomes resistance. You can see we tested it on 19, and that imbalance, these trap traders, are what leads to a second leg down. So bear breakout 18, pullback, testing, resistance, sellers into the close, probably going at least a little bit lower. Is it always in short? I'm not sure. I think it is always in short, but it's a little risky at this point because most of the bars today are above the moving average. We had a gap up, and now we're on leg one, pullback, leg two, pause, and actually a pullback, and then 21 might be leg three, 1, 2, 3. So a possible wedge bottom. 21, like 18, is a bear breakout, but it needs follow through. And then 22 is disappointing follow through. So now we have a gap up with follow through, 3 pushes down, and a possible higher low major trend reversal. So when you get bar 23, that's an always in flip. So if the market was always in short, at this point, the bears have to get out of shorts and the bulls can buy, taking a chance on a major trend reversal. Bear trend, trend line break, retest, and then 3 pushes down, wedge bottom, higher low, and a good signal bar for the bulls. So a bull breakout bar, the bulls want follow through. 24, the bulls get good follow through. 24 is an even bigger bar than 23. It's crossing the moving average. Most of the bar is above the moving average, and it's closing on its high. So consecutive bull bars closing on their highs, both of them fairly big. This might be a leg one breakout. And whenever you have a leg one breakout, actually let me back up before I get into that. I wanted to mention something about the market cycle. So here, bars 10 through 15, the bears get a spike, then we pull back and we start to channel down. But 3 pushes down. Here's the start of the channel, bar 17. So at this point, bar 22, what's the probability the market falls down here before we come back up here? If we think through the market cycle, we know that the market has a breakout, it pulls back, that's the start of the channel phase. It'll channel down in this case, and channels evolve into trading ranges. I mentioned that at the beginning of the video. Bear channels have a 75% chance of getting a bull breakout, and most of the time the market comes back to the start of the channel. So at this point, it's more likely we're going here than up here, unless the bears start getting more momentum. But that's a problem for the bears, and that's an even bigger problem. So now it's more likely, of course, we're going here, and the bulls are thinking about a measured move for themselves, maybe based on the bodies of the breakout. That gets us back to the bar 9 low, and that's reasonable, makes sense. We're expecting the low of bar 9 to be resistance because it was a tight bull channel. It's a bad stop order signal bar, but if you sold below 9, you would have made money. So bulls who bought here are trapped, bears who did not sell are trapped, and this should get a second leg down. Even though it's 3 pushes, it might just be one leg, one breakout on a higher time frame. But 23, 24, certainly 24 flips the always in back to long if it was ever short. And then more follow through 25, 26. In terms of breakouts, this bull breakout scores pretty high. You're getting time control by the bulls, so the market's going up for 4 or 5 bars. The bars are uniform in size, they're not climactic, there's very little overlap. Most of the bars are closing on their highs. Plus the context is good. Gap up and follow through, and then a possible higher low major trend reversal with a wedge bottom, and then a really strong bull breakout. Again, this is leg 1, and leg 1 resets the market cycle. So as long as the market's in leg 1, in a bull leg 1, you should not be selling. The only reason for selling is if you bought somewhere down here and you want to reduce your risk. But otherwise, there's no reason to initiate a short in this context. Leg 1 breakouts have a very high probability of getting a second leg. And until there's decent selling pressure, there's really no reason to look to sell here. So the market is going higher. We're getting close to the high of the day. You can see bar 9 low, the market really didn't hesitate there. So the market is just plowing through resistance. This is a strong bull breakout. And then an outside bar, 31. 31 is either a measuring gap or an exhaustion gap. The bulls, they're hoping it's a measuring gap. We go from the bottom of the bull leg to the breakout point. We go all the way up here. Is that reasonable? Well, if you think about it, the average daily range for the past 9 or 10 days has been about 75 points. So if we go to this price, the daily range would have to be about 67 points, so that it is reasonable. Plus, at this point, there's at least a 60% chance that we've seen the low of the day. By bar 18, there's about an 80% chance we've seen either the high or the low of the day. And of course, at this point, it's more likely that we've seen the low. Plus, if we go back over here, I mentioned the triangle. Triangles are areas of agreement. They're trading ranges. And 50% of the time, you get a breakout of a triangle, the market reverses and comes back to the apex of the triangle, somewhere in the middle. And one price you could use for the middle of that range is the close of Thursday, bar 81, or you could use the open of Friday. But in any case, it's either one of the two. That's a reasonable place to look to take profits if you're a bull. And how does that line up with the measuring gap, measured move? You can see those two prices are pretty close to each other. Or maybe you look for the opening range to double, and that takes you up here. So there's a cluster of magnets above, and so far the bulls are doing a good job. This might be a small pullback trend. Minor reversal. We've had, this was maybe a 10 bar micro channel. So is 33 going to reverse this bull breakout? Is this a double top? Probably not. There's not enough selling pressure through here. Now, one concern might be expanding triangle. Maybe you draw it something like that. I think it was more clear on the Globex chart, but in any case, this looks too strong. I don't think there's any reason to look to sell at this point. You can argue there's a bull climax, a pause, climax, pause, climax, pause. So maybe consecutive climaxes, 3 pushes up, but this looks like a breakout on a higher time frame. It's a tight bull channel. It's hardly getting pullbacks, and it's hard to create an argument for the bears when that's the case. There's very little selling pressure. The context is not very good. Moving along, we have 3 or 4 pushes up here. It's a micro wedge top. The bears are hoping we reverse below bar 42, but it's a first. You can call it a first reversal. You could call it a second reversal. We fell below bar 37, but went to a new high, and then we're getting another reversal. So 42 could be seen as a low 2 or a low 1. In any case, we triggered the sell, but it was minor. But then we got bar 45, and bar 45 is certainly a second reversal. And whenever you have a bear bar closing below its midpoint, especially closing near its low, and you're getting a lot of resistance, the market's trying to break out of this price level, but failing many times, and then you get a bear bar closing near its low, the bulls will take profits. They'll just exit below 45, expecting a correction, maybe a pullback to the moving average, and then they'll look to buy again later. As far as selling here, though, it's not ideal. There's not a lot of selling pressure, not really much of a trendline break either. High 1 but didn't trigger. And then bar 49, bear breakout of a bull flag. So this might be a surprise. The market's in a bull trend. We're getting a bull flag, and then we get a bear breakout of a bull flag. That's not supposed to happen. And therefore, that's a surprise, and 49 should get a second leg. You can think about it as a vacuum test of the moving average, and 3 pushes down, 45, 47, 49. But 49, like I said, might have reset the leg count. It's a surprise, and surprises usually get second legs. So bulls buy the moving average. It's a deep pullback after the bear breakout, but we're testing the low of 48 where traders got trapped, so there's probably resistance here. And then 51, we went outside down. But then, just like 49, 51 also had bad follow-through, a couple of bull bars closing near their highs. Not ideal for the bears. However, 51 was a big bar. It broke out a decent distance below 50. The low of 50 is expected to become resistance, and 51 should get a second leg down. What about buying 52? Is it a high 2 in a bull trend? Bull trend, high 1 here, high 2 here. The problem with 52, we're getting an endless pullback here. The bears have a trend line that has not been broken. So if you buy here, you might be buying high in a bear channel. I see the argument. Maybe it's leg 1, pause, leg 2, pause, leg 3, and the pushes are getting bigger and climactic, but this might all be a breakout on a higher time frame that needs its own second leg. Let's also not forget about the sell-off earlier in the day, so the odds that this is a small pullback trend for the rest of the day are not very high. Here's a 50% pullback of the rally, which I mentioned are common, especially in trading ranges. So 52, even though it's a decent bull bar, probably sellers not far above, and then we remained inside on 53. And it's a low 1 short. We're expecting a second leg. Maybe there's sellers below, but I wouldn't be surprised if bulls are buying a position, betting that this breakout, even if it gets a deep pullback, will get a second leg up. And then 54, bear breakout, 55, follow through. So bear breakout and follow through, but at this point, 49, 51, 55 might be 3 legs down, testing the 50% pullback. So not an ideal place to sell, but strong enough breakout for a second leg and tight bear channel. So probably not going to just reverse from here. Bad follow through, getting some overlap, an outside bar, but probably a minor reversal. Micro channel since 51, so the odds are sellers above, scaling in higher, probably going to get a second leg, probably going below bar 58. Inside bar, so IOI, bulls are hoping it's a reversal setup, but the buying pressure, decent bull bars here, but not much through here. Probably a minor reversal, sellers above for a second leg down. And then we went outside down, we went to a new low, but buyers, 61's a better buy. It's a double bottom, high 2, but still in a tight bear channel, so not ideal. I apologize, I had to pause there for a couple of minutes. I think I left off here. I was talking about bar 61. It's a high 2, but we haven't had a trendline break. It's still a tight bear channel, so we may have to still go lower. But is the market always in long, or is it always in short? It might be always in short, but the market's in a trading range. Big down, big up, big down. So when it seems like it's clearly always in short, the market can reverse pretty quickly. And always in is a dangerous concept in trading ranges. It's better for swings and trending environments. So probably sellers above 61, but it looks like the bears are starting to run out of momentum. We're testing a breakout point to the left, the bar 18 high, or at least coming close to it. 1, 2, 3 pushes down with maybe a nested wedge in there, and starting to get some buying pressure. And then another sell climax on bar 62, but then look at 63. No follow through. So maybe it's 1, 2, 3 pushes down, 58, 61, 62. Also, look at bar 62. It's almost 11 points. That's the biggest bar since bar 51. So that might be an exhaustion gap, more climactic, and the end of the move. And the odds are we're going to come back and test at least the low of bar 61. It's a bad stop order signal bar. And you can see we did that and more on 63. So 63, maybe it's a wedge bottom, and we're testing this breakout point. This may be starting to get its second leg after a deep pullback. But 63 is a big bar, so big risk. But if you're going for, I don't know, maybe the high of the day, it's a reasonable trade. And you can always buy small and build a position. So rather than buying a full-size position here, maybe buy half your position and scale in if the market goes against you, or press the trade if it goes your way. So it's about 2 to 1. It's a reasonable trade above 63, but still not ideal until there's a trend line break. But because of the context, this bull breakout should get a second leg. Now we're getting consecutive sell climaxes, testing a breakout point. It's reasonable to buy. And then, is this strong enough to reverse 63? 63 reminds me of 23, 24. Sell climaxes in both cases, and then a decent breakout, and it might be leg one. So leg one typically gets a second leg, and the reversal attempt here, 64 through 66, is kind of like bars 2 through 4. Are these enough to reverse the gap up? Probably not. Are these enough to reverse bar 63? Probably not. We're probably going higher. 67, bear breakout. But look where we are. Might be a 50% pullback. Maybe deeper. But you can see we're getting a bear breakout of a bull flag, bull breakout, bull flag, bear breakout, but the bears probably need at least one more bar. And even if they get it, if you think about sell the close bears on bar 62, they're disappointed with 63, and they'll use any pullback to exit their shorts. And you can see they didn't get there. So if a bear sold the close of 62 and sold more below a bear bar, 60, 65, this red line is their average price. And right when we got to their average price, they took it. They took break even on that trade, and the market is reversing up. This may be the start of a second leg up. Inside bar, IOI, but in a sideways market, kind of meaningless. The market's not reversing anything. It's not a flag in a trend. We're just going more sideways. Bull breakout attempt, but failed. The bears looking for a double top and a reversal bar closing on its low, but it's basically a doji. We're getting higher lows. There might be buyers below bar 70. And then 71, maybe a high 2, bull breakout, high 1, deeper pullback, high 2 above that doji. And then a good entry bar crossing the moving average. But then bad follow through, 73. We've had a lot of bars below the moving average here. And even if we do rally, we know that the bulls are disappointed. Bulls who bought 52, buy the close bulls, disappointed. If we get back there, they'll probably exit their longs. Bulls who bought here, they buy more lower. Maybe they buy above bar 71. Let's see what that break-even price is. So you can see 73 is the bar that reached that break-even price, and the market tested it and pulled back. Bulls are exiting, disappointed. Continuing higher, 3 pushes up, we may pull back a little, but micro channel since 71. First, reversal, probably going to fail, probably buyers below 75. Bear breakout attempt, but weak. Entry bar. Outside bar, we're going lower. We're testing a stop order. So maybe a bull doesn't buy above bar 71. It's consecutive dojis in a tight trading range, but then there's a good bull breakout. So bulls are trapped. Then you have bears who are betting against the high 2. They're saying this is a bear channel. We have not had a credible trendline break yet, so they can sell here, scale in, and they're disappointed. So now there's support at the bar 71 high, the stop order price. And you can see bar 77 came back and tested that bar. Looks like to the tick. Let me double check. We came maybe within a tick of testing that, the high of bar 71. Now we have a double bottom. We may have to rally, but even if we do, 77 is a bad stop order. Signal bar, the bar is big and it's weak, and if we go higher, there's probably disappointed bulls not far above. 78 vacuuming up, but possibly consecutive buy climaxes, and then 78 had bad follow through. So we're getting bull breakout bars with bad follow through, and disappointment like that is characteristic of a trading range. You can see we're testing the bar 52 close, and the market ended up going a little bit higher, but overall looks like a trading range. You could also call it a bull channel, high, higher high, low, and higher low. So it's a broad bull channel. And when the market's in a broad bull channel, you can trade it like a trading range that is sloped. So you want to sell high and buy low. For stop order trades today, with the gap up and follow through, maybe you can buy above bar 1, but in general, usually better to not trade before bar 6 because reversals are really common, especially coming into the day. And if you give it the first 6 bars, there's really not a great stop order trade. Maybe it's always in long, you buy above 8, but then you get 9, which is climactic, and then 10, you probably get out below bar 10. And bears can sell below 10, they can sell below the low 1, bar 12. And it might be always in short, but the problem is the gap up and all the bars are above the moving average at that point. So if it's always in short, it's not very strong, especially when you start getting 3 pushes down, consecutive sell climaxes with bad follow through. 23 is a credible buy. It's a good signal bar. Context is good. Possible higher low, major trend reversal. 24 you can buy. It's by the close. Through here, buy for any reason, always in long. But then you get a reversal attempt below 42 and a second reversal 45. At a minimum, bulls can exit below 45, but bears can also sell, but it's aggressive. And the expectation at that point is a test of the moving average, maybe a test of the bar 9 high. That's a breakout point. There was some resistance there earlier. We came back down and tested it again on 51. Through here, stop orders were not ideal. Maybe you saw the low 153, breakout and follow through 54, 55, but really not ideal through here. And then I mentioned 63. Maybe you buy, but the risk is big. The signal bar is big. And you're buying at the top of this smaller trading range. So when your entry bar is disappointing, maybe you just exit. And then there's a high 271. Maybe you buy that, 72. You get a bull breakout, higher probability to buy, but then bad follow through. Maybe you just get out of that trade. And that's about it for stop orders. I already mentioned the day type today. It's more of a bull trading range day. You can call it a broad bull channel. But you can see the market opened here. Get rid of some lines. The market opened at this red line and closed up here at this red line. But if you think about it, here's the open. The market has a tail below, and here's the close. The market has a tail above. So there's a bull body on the chart, and this is a little misleading if you're looking at this daily chart because that's the extended hours. So this is what the day looks like with this chart, the day only session. Big tail below, tail above, relatively small body. I also meant to mention that coming into the day, Friday was a fairly big day, one of the biggest days we've had recently. And then today gapped up and opened right around the midpoint of yesterday's range, Friday's range. And because of that, I thought there was an increased chance that today would remain an inside day. So here's the midpoint. You can see we opened just below it. We tested the midpoint around here. most days do break out. Most bars are breakout bars, but certain contexts, there are exceptions, and I thought today was one of those exceptions. And where do we go tomorrow? So big down, big up, big down. The market's testing about 50% of the rally. We're testing a breakout point, this measuring gap, measured move. And the market's rejecting that price, or in other words, there's support at that price. So sell climax, bad follow through, sell climax, and then inside bull trend bar, it's a reversal attempt. Now we do have a 4-bar micro channel, really a 5-bar micro channel now for the bears, and we probably need at least a double bottom before we reverse this sell-off. But the sell-off may not be very credible because it's occurring within an overall trading range. It's getting big climactic bars with bad follow-through. So I think there's probably support at the midpoint of today's range and below. And overall, even in these two past bars, you see it's big down, big up overall. But even here, it's big down, big up, and big confusion. So I'm expecting more trading range price action through here. All right, thanks everybody for watching, and I hope everyone has a good night.